The Reserve Bank's Monetary Policy Committee meets next week in the best of backdrops. Growth is higher than expected, inflation is lower than expected. So, what should the MPC do? As always, CNBC TV18's Citizens Monetary Policy Committee meets to deliberate on the issues before the RBI and what should be done with rates and the MPC stands. I have with me Chairman Pronab and members Samiran Chakraborty of Citi, Soumya Kanti Ghosh of State Bank, Sajjid Chinoy of JPMorgan and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much indeed for joining me. Samiran, let me start with you. And, GDP is top of the mind. So I must first ask you that. What elements from the GDP will impact monetary policy making at all?
So, Lata, as you rightly mentioned, that it's kind of a Goldilocks situation for RBI, good growth, lower inflation. But sometimes the higher growth number also worries the central bank that it could lead to inflationary pressures going forward. But this is one of those situations where there is good news even there. If you look at the structure, the composition of the growth, it's more towards the investment side of the economy, and consumption is actually a little weaker. Yes. So maybe this will not translate into any immediate pricing power issues and inflation issues, core inflation issues. So to that extent, I think RBI would be quite happy with the growth number. In fact, we would not be surprised if there is a marginal upward revision to their own growth forecast for FY24 from the 6.5 that they have currently.
Oh, okay. Now that's very important. If they're going to if they revise it even upward, extremely positive. Okay, of course, the big worry for the MPC is always inflation, and that's not a worry at this point in time. So, Sonal Varma, on that, do you think the inflation trajectory may have to be redrawn for the same reason that Samiran is saying? Growth is very strong. So, will there be any rethink on the inflation trajectory? And, if it is not, is there a chance of a cut then?
Right, Lata. I think so. First thing on inflation, there is actually a need to redraw the inflation trajectory, but on the downside, not on the upside. The higher growth, as Samiran mentioned, is not leading to inflationary pressures at all. In fact, in Q1 FY24, average inflation should be nearly 60 basis points below the RBI's projection of 5.1. So we already have data in hand that suggests that the year is starting out on the softer side. And if you look at the forward-looking path for inflation, I think the biggest uncertainty right now is on El Nino and what it means for food outlook. But as far as the input cost pressures are concerned, with respect to cost pressures on food are coming down, the input cost pressures for manufacturing are coming down, which is yet to reflect in core goods inflation. And services actually have not really seen a massive increase as was feared. So just on the basis of lower Q1 and moderating input costs, we do think there's actually a case for a downward revision. So compared to the 5.2, at the margin, it should be brought down by maybe about 10 basis points just to align it to lower Q1. Whether the RBI does that or not, given uncertainty on El Nino, is another issue. But we don't really see upside to RBI's 5.2. I think at the margin, the risk to inflation is actually it'll end up being lower than 5.
Okay, that'll be a great monetary policy if the Reserve Bank, two headlines that come out are growth revised higher and inflation revised lower. And if I'm not mistaken, Samiran, you've already revised it lower to 4.9. For the current year, the Reserve Bank itself stands at 5.2. Okay, then the other big thing is the global backdrop. Sajjid, since you are away from India, maybe you're best placed to parse the global takeaways. For the Reserve Bank, there were rate cut expectations building up in the last 3 or 4 weeks. Apart from the debt ceiling drama, the expectations of rate cut are actually coming down, especially after the FOMC minutes. So your take, what should the Reserve Bank worry about on the global scenario? Rate differentials, is that a worry?
Lata, for the last 12 months, analysts and economists have been in this recession frenzy and worried about an imminent global recession. Every 6 months, economists say the recession is coming in 6 months, but the data has consistently gone in the other direction. Remember, the first quarter of 2024 was going to be the quarter that many economists had predicted there'd be a US recession, and the global economy would stumble because of that. Guess what growth in the first quarter is? It's tracking above 4% globally, right? Much above trend. Now, of course, some of this is the China reopening, but even if you take the China reopening out, both developed markets and advanced economies have actually accelerated going into 2024 in the first quarter. So growth is much stronger than had been anticipated. Second quarter is slowing to about 2% to 2.5%, which is close to trend growth. Why is this happening? Why are we getting consistently surprised on the upside? Because everybody's focusing on one shock, which is the monetary tightening and the 500 basis points of rate increases by the Fed and the 350 basis points of increases in Europe, and the fact that that's going to cause a slowdown. But there are other things going on at the same time. Many of the adverse supply shocks from COVID, from the war, are reversing, and that's helping inflation and helping growth. Global inflation was tracking 9% on a sequential annualized basis in the first half of 2022. It's now tracking 3%. And what lower headline food and fuel inflation does is increase purchasing power for households and boost consumption around the world. So the first point I want to make is global growth is holding up much stronger than we had expected. Now, this is not, however, a soft landing story, because the bad news is that advanced economy core inflation seems to have gotten stuck at close to 5%, right? And so that, in a way, the fact that inflation is so sticky globally, core inflation is sticky, not headline, is sowing the seeds for a recession at some point in the future, because monetary conditions will have to remain tight. But the point is, there is no imminent recession. Now, this has two implications for India. The first is the worries that we had about global headwinds is clearly lower. I think what's sometimes forgotten is that much of the upside surprise that happened in the GDP print 2 days ago was because of stronger exports. If you look at the NSO's implicit export number for the first quarter back in February, it was 4% growth in exports. The actual turnout was 12%. So much of the upside surprise between 5 and 6% growth can be explained by stronger exports. So that's the good news, that the global economy, at least in the near term, will not be as much of a source of pressure on India's growth as we had worried a year ago. The worrying part is that advanced economy central banks may not be able to stop just as yet. The Fed may pause in June, but if the data continues to remain as strong as it is, markets are now pricing in some rate action by the Fed in July. And so to the extent that these rate hiking cycles around the world go on much further than we had thought, that constrains the ability of emerging market central banks, including the RBI, to ease anytime soon.
Okay, got that. The present is brilliant, but the future is cloudy and therefore data dependent. Soumya, the most important thing is liquidity. I mean, we were almost getting into negative liquidity, deficient liquidity in the interbank system. Banks were going and borrowing from RBI repo. Suddenly now this 2,000 rupee note or whatever, there has been a deluge of liquidity. So how do you tie that in? Does it mean the stance remains removal of accommodation? And anyway, anything more that they should ponder over liquidity?
Yeah, thanks, Lata. I think as Sajjid was mentioning, the uncertainty part actually has taken the center stage, and it's evident everywhere in terms of the data. Even in the liquidity today, I think liquidity was a constraint at the beginning of the year. However, liquidity has now improved much better than the earlier what it was in April, perhaps due to two reasons. The first thing, obviously, as you said, the withdrawal of the rupees 2,000 rupee notes, and the initial trend suggests that a large part of that is actually going into deposits. Of course, this data could change, but even if you do one simple maths, that could have a bulge in the deposits, which could have a bulge in the liquidity, which could be in excess of rupees 1 trillion. That is the initial trends, but that is actually a favorable one. So the second point is that I think in the last 2 months, the total portfolio capital inflows has been in excess of 7 billion.
Yes.
So this is actually has been a massive number, and markets are actually climbing a high every day, even as we speak today. So in that context, I think the central bank also has to ensure that that liquidity which is coming into the system is properly absorbed. So there are 2 points. One is the withdrawal of the 2,000 rupee notes, which could lead to an additional bulge in deposits. The second point is the purchase of dollars from the market. So there the central bank will have to take a call whether it wants to add to foreign exchange reserves or it wants to let the rupee find its own course. That's a debate which I can do separately. But my sense is that I think the central bank as of now will be best placed to continue with the current stance which has adopted, because at this point of time there is no point in getting into a situation whereby you move into a neutral mode, because things can change pretty fast at some point of time. So my sense is that it continues with the withdrawal of accommodation, given that these two favorable uncertainties has come into the picture.
Okay. Well, both those we will debate. The fact that exports and what should the rupee do. There was one big exporter who told me that he owes his excellent performance solely to the management of the rupee. He wants depreciated rupee. So there could be that part. In any case, that issue later. Dr. Sen, what I wanted to ask you is, growth is doing well and inflation is falling. As Samiran has already put out a paper, he's cut the inflation forecast for the current year to 4.9. I think Sonal is also hinting at that. When do central banks cut? Do they cut when inflation is falling, or do they cut only when growth is in danger?
Well, as far as when they cut is a judgment call. If inflation falling is no reason to cut. It's only if inflation is falling at a rate where you are in danger of going into a deflation, then a cut becomes justified. But the growth argument, weak growth always supports a rate cut.
Okay.
Now, at the moment, there are no signs of weak growth happening. And inflation is unlikely to go into deflationary territory. I mean, however much the inflationary trend moves downwards, it's not going to go down very much below 5%. So I don't think there is any great reason why rate cuts should be resorted to at this point in time. Indeed, not in the immediate future either. So I think that one should simply put off the table. The real question, I think, Lata, is the nature of growth what we would like it to be? As I think Samiran pointed out, it is heavily skewed towards investments. Now, when you have a growth rate of 6.1% and consumption is growing only at 3.8%, you really should start worrying.
Oh.
Ideally, what one would like is with a 6.1% GDP growth, consumption should be growing at somewhere around 5.5%. So this weakness in consumption is something we need to worry about. Okay. Now here comes the whole issue, which is that although systemic liquidity has improved significantly, but the likelihood is that currency in circulation would have gone down.
Yes.
And that would hit essentially precisely those components of our overall consumption demand, which are the most vulnerable.
Okay.
And that is something, so this is not something for the MPC to worry about. But I think it's certainly something that RBI should be worrying.
Okay, Dr. Sen, that's a lot of food for thought. We have to discuss all these issues. A quick break, we are back, and at that time, we will have our members voting on the rate action and the stance. Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC TV18. I have been speaking with Chairman Pronab Sen and members Samiran Chakraborty, Soumya, Kanti, Ghosh, Sajjid, Chinoy and Sonal Varma. Gentlemen and Sonal, thank you very much for waiting on. Samiran, now to certain ambience questions or ecosystem questions. CRR cut. I mean, we were all hoping that at some point we will go back to the pre-COVID CRR, which was raised during COVID. Now that's out of the window completely.
It's slightly more difficult now because not only is the banking system liquidity improved, it's actually the durable liquidity which has also improved substantially. So apart from what we have already discussed about FX intervention and the impact of this 2,000 rupee note withdrawal, we have to also remember that the RBI dividend to the government has been much more than expected. And that does not immediately add to banking system liquidity, but it adds to durable liquidity. So durable liquidity has already moved closer to 90,000 crores from 50,000 crores. And our sense is once we are accounting for these dividend, etc., we'd be seeing a durable liquidity number 1.5 to 2 lakh crores. Now, with that sort of durable liquidity in the system, it's difficult to imagine that RBI will opt for an immediate CRR cut. And clearly, the open question is that this will push back the any sort of open market operations also to a latter date is what our sense is. We have brought down our OMO expectations, but even that looks increasingly difficult unless liquidity becomes tighter.
Okay, you want to add to that, Soumya? I mean, the market will be watching only what he says about OMO purchases. You think that's out of the window? And anything you wanted to add on rupee management? I mean, my sense is with the yuan depreciating, the RBI is one eye on rupee depreciation as well. Anything you want to add?
No, I think I broadly concur with Samiran's point. I think liquid, given the fact that significant improvement in durable liquidity, I think the questions of CRR and OMO now is out of the window. But I would like to add one point over here. I think the central bank, but this may not be a realm within the MPC, but the central bank, given the fact in terms of liquidity management, the central bank also needs to think about the foreign exchange part. And that has a direct bit in the liquidity management because Indian rupee, which was perhaps one of the best performing in COVID, has actually depreciated even as other currencies have appreciated in the last 2 months as the dollar has actually weakened. So my sense is that the central bank could actually resort to other intervention strategies like swap transactions, which could bring down liquidity and at the same point of time could lead to some point of appreciation of the rupee. The rupee has appreciated a little bit in the last couple of days, and there is already 12 billion outstanding forwards in the 3 to 12 month breakup of the RBI. So maybe that could be an option that you kill two birds with one stone. You reduce liquidity by doing maybe a sell by swap and allow the exchange rate to appreciate a little bit, because that will also be good for the in terms of an capital inflows.
Okay.
So
got that. So your expectation is let them intervene, but intervene without increasing liquidity too much through the forward market. Okay, time permitting, I'll come back to that. But Sajjid, if it is going to be good growth and low inflation, chances are the Reserve Bank will pause. I mean, the growth anyway doesn't need a cut. Now, how do you communicate a long pause? You can't keep on with this withdrawal of liquidity for too long. So how will they communicate that we are on pause mode for a goodish bit?
Lata, this is a good problem to have after a difficult 2022.
Yeah, of course.
The RBI finally finds itself in a bit of a sweet spot. As you said, growth is higher than was projected. And at least in the next 6 months, headline CPI is going to be 60 to 70 basis points, below their existing trajectory. But we need to be careful. There is no room for complacency here. I know there'll be a clamor among markets to say, why not change the stance to neutral? The issue I have with that is, if you look at where monetary conditions are in the last 2 months, so since the April policy review, US 10-year yields have actually gone up by 30 basis points. But Indian yields, whether it's the 5-year OIS, 5-year bond yields, 10-year bond yields, are actually down between 25 and 30 basis points, right? So what you find is any measure of real monetary conditions is already much easier today, despite the rate hikes, than we were in the pre-COVID level, level. And we need to be careful here that, monetary conditions don't ease too prematurely. So if the RBI were to signal at this point that the stance is going to move to neutral, unfortunately, markets will jump the gun, presume that rate cut is coming soon, and financial conditions will ease further. We already spoke about the fact that core liquidity, The surplus has almost doubled from the start of the fiscal year to today. So we need to be a little bit more vigilant because there are multiple uncertainties that we still confront. It's been a good 2 months, but Sonal spoke about the risk of El Nino. Core inflation has just begun to come off the last 2 months. We need to make sure that it endures. We know goods inflation should come off, but services inflation is the dog that hasn't barked. And could you get, some services inflation down the road? And we don't know what the Fed's going to do. So given this plethora of uncertainties, I would say the RBI should at this point stay the course, not prematurely change the stance to neutral. Of course, the communication, as the RBI has been good at, can be more nuanced. It doesn't have to be nearly as hawkish as April. And the idea should be we're on a prolonged pause, but not create any expectations of a rate cut anytime soon, because otherwise monetary conditions will ease to the point that you're undermining the hard work of the last year.
Would you agree, Dr. Sen? Because, global commodity prices are falling and, people are actually revising down even domestic inflation. So why not call a neutral? Why not signal that we are done with the hawkish phase?
Lata, if you recall our last couple of meetings, Sajjid and I have been daggers drawn on just this one particular issue.
Okay. Yeah,
Sajjid has refused to let RBI go neutral, and I've been insisting that they should. So this is a debate that just continues.
Okay, fair enough. We will know. We'll know soon when the vote happens. But let me toss that now to the third person, Sonal Varma. Sonal Varma, you're very clear that there is going to be a downward revision of the inflation trajectory. So are you expecting a cut? And do you think RBI should signal that by changing its stance right away in June?
Yeah, Lata, so let's split this up. I think, first of all, here and now, we are in a sweet spot, but inflation is not yet close to 4. So I think to be changing the stance and signaling anything right now would be premature. And therefore, I think keeping the course on withdrawal of accommodation is fine to signal that it's a pause, not a pivot.
Fair enough. That's well defended. But now you have to take your pens and vote, or actually push your buttons and vote. The first question, obviously, to my members is, will the MPC hike, cut, or pause on June 8th? Samiran, I start with you. What will they do?
I think it's a pause.
Pause. Soumya?
It's a pause.
Okay. That's 2 votes. Sajjid?
I think it's a pause.
Pause. Sonal?
Pause.
Pause. Okay. Chairman, 4 pauses. What about you, sir?
Pause. 5 pauses.
Okay. All right. The chair pauses. So that's a 5-0 in favor of a pause. That will be a relief for the market. Stance will be more important. Current stance. Will MPC retain stance at withdrawal of accommodation or change? So, Samiran.
A marginal call, but I will probably side with retain.
Retain this. Okay. Unchanged stance.
Stance will be unchanged.
Unchanged stance. Okay. Sajjid?
A retain stance, though you can soften the language a bit, but retain the stance.
Okay. Retain stance. Sonal?
Retain stance.
Yeah. You argued that very strongly. Dr. Sen?
Well, I would argue they should change. So I would have said neutral, but I suspect what they will actually do is retain the stance.
Oh, okay. So we'll go with neutral since that's your vote. And you've been holding that from the time of the last cut, of the last hike, yes. The final question, and I want to squeeze this in. When do you see the first rate cut, Samiran? Because the market is looking for one.
Well, our sense is it's still somewhat down the line, not immediate, and it will obviously be extremely data dependent, not just domestic data, but as well as global data.
So I'll put it as data dependent.
I think it's far away. It's completely data dependent. So not as of now.
Okay, so not as of now. Sajjid?
Again, very data dependent, not as of now, but based on baseline, nothing before the end of this year, December at the earliest, but very data dependent.
December. Oh, that's important. December. Sonal?
Earlier than expected. I think the growth, as I argued, will disappoint. So we think it'll be October.
October. Oh, good. Market will be very happy with you. Dr. Sen?
Well, data dependent, obviously, but I don't think From what indications we have, it's going to be within this calendar year, which means
So
I'm more
not
or
in
less with
23.
Sajjid on this.
Okay. Thank you very much, members of the Monetary Policy Committee. It's a pause. The stance more likely will be not changed, but we will look for any suggestions of whether the governor hints about a cut. Thank you very much for watching this very special show.